Good morning, hello, and welcome to this live and exclusive webinar on Option Express. Today, I will be covering the most used tools by the options traders every single day. So we have plenty of tools available on the Option Express, which will be of very much of use to all the options traders. So let's dive on to the presentation that I have created. A few slides I've created, and we can go through what we'll be covering. So let's go on to the slides. So first of all, my name is Sumit Agrawal, and I'm the Senior Product Manager for the ICICI Securities in the derivatives domain. So I cover all the products related to derivatives. And one of the product that we have right now is Options Express. Previously, I have covered a few more products related to options like options payoff analyzer, basket orders, trading view charts, and everything else. So this webinar is for Option Express, and we will be covering this the whole Option Express in two different parts. So today I'll be covering a strategy deck. Second is option chain, scanners, and a few option concepts that I'll be touching upon, because that is required in order to understand how to use Option Express wisely. The second is in the part 2 I will be covering a few more tools available on the Option Express. Nevertheless, I will be giving you a recap of what we have covered in the part 1 as well, so that you get the feel of so that we are actually in the flow of that. So in part 2, we'll be covering screeners, open interest. That too, I will be explaining that in detail. Gainers and losers, price calculators using Black-Scholes model, and a few more option concepts, so that you'll be able to trade using Option Express thoroughly. So let's dive on to the Option Express on ICICIdirect platform. Just give me a sec. Yeah. So I've already logged into my account, and once you click on Option Express, this is the screen that you will be able to see. So in order to go to Option Express, there are two ways to go to Option Express. The first is you can click on this plus sign here, and then right at the left at the top, you can see this Option Express blinking over here. So you can click from here, you can go onto the Option Express. This is the first way. And the other way is you scroll down a little bit down, and we have this smart option analysis tools available over here just above the sensible. So you can click on Option Express from here as well. So whichever way you want to do it, you will be easily able to access this Option Express. So let me click on the Option Express, and we can go through each of the components of the Option Express one by one. There are plenty of things that we have to cover today. So as I mentioned in the beginning, that I'll be covering only a few of the the components of the Option Express today in this part 1, and the rest of the things we'll be covering the part 2. So for part 1, we'll be covering strategy deck, which is given over here. Then the option chain, will be covering all the components related to option chain, how to use it and how to place the orders. Then comes the scanner. So when you click on the option chain, for me it lands me directly onto the scanners, where you have all these bearish, bullish, and several different tools available to browse through. The other in the second part, I'll be covering screeners, open interest, price calculators, gainers and losers, and a few more option concepts, because all these things take quite a lot of time to understand. So that's why I've broken down this webinar into two different parts. So let's start one by one then. So the first is strategy deck. So let me click on the strategy deck. So strategy deck is basically nothing but the strategy recommendations it gives you based on your view. So in here you will see this Nifty is pre-selected. So Nifty is there. Next, you need to select the expiry that you wanted to trade on, whether 30th June, 7th of July, 14th of July, all these expiry dates that are available. So let's go with the 30th of June. My view is, let's say, above, and the current market price going is around 15,733. So let me put 15,700 over here, and if I click on go, I should get, it will throw me plenty of strategies because my view is above 15,700, which means that on the day of expiry, I'm expecting the price or the market or the Nifty to close above 15,700. Where it is going to close, that I don't know, but but I'm expecting it to close above 15,700. So based on that, based on quant analysis and everything, there are like 20 different trades have been suggested, and these trades are nothing but bull put spread, bull call spread, based on both call and puts, and then the expiries that they have thrown is 30th of June. So if you want 7th of July expiry or 14th of July, you can just take it, or you can just simply untake it if you don't want to trade these expiries. Next on the left hand side is the spread gap. This is nothing but a gap of the spread basically. So let me give an example. Let me untake this for ease of understanding. So let's say I'm going with a 300. Okay. So 300 is nothing but bull put spread. It is giving me an example of, so 750, 15,750 and 15,450. So this is the difference between the two spreads, which is nothing but 300. So if I click on 350, it is giving me another spread which is having a difference of 350, another spread with 400 gap, so on and so forth. So you'll be able to select all the strikes depending upon the spread gap that you want, because there are plenty of options traders out there. They would like to trade in certain gap of the strikes. So let's go with the 300 strike, 300 spread gap. So the first one was 300 spread gap. Over here what it gives you is, which is nothing but a bull put spread. So what it says is, my view is above. So if the market goes up, I should be making a profit of about 2,545, and the break-even point will be somewhere around 15,649. The price. So all I need to do is just click here, and if you want to see the call spread or put spread, you can just take over here. So let's go with the call spread first. So bull call spread is nothing but for the 30th June. Today is like 28th of June. So we have like 2 different days, 15,400 and 15,800. So this is like a 400 gap spread. My profit is going to be about 1,055 rupees, and my break-even point will be 15,678. So let me just click here. So once you click over there, what you'll be able to see is the summary of the strikes that you will be trading. So what it says is Nifty 22nd of June, 15,400 call is what you will be buying, and at the same time Nifty 2022 June, 15,800 call you will be selling. So the gap of 400 points over here, and the overall LTP over here is 278.90. So what this LTP is nothing but 362.5 minus 83 rupees. So once you calculate these, you will get this 278 rupees. So this is what the premium that you will be paying. So once you pay this total premium of 278 rupees, this is the maximum loss that you're gonna get basically. So what is the maximum profit then? So maximum profit is nothing but the difference between the two strikes. So difference between these two strikes is nothing but how much? It is 400. So 400. Let me just open up the calculator, so it will be much easier for you to understand. So 400 minus the amount that I'm paying basically. So how much premium that I'm paying is 278.90. So 278.90, which is nothing but 121.1. If I multiply this by 50, because that's what I'm trading with, just one lot over here at the moment. So this is what my maximum profit will be. I hope you understand this calculation, because this is plain and simple. The amount that you are paying as a premium for the combined bull call spread minus the difference in the strikes is nothing but the maximum profit that you will gain on the day of expiry if the market closes above, the 15,800, or it goes above that. So that's how it will be. So this is nothing but a numerical calculation. If it is difficult for people to understand what is happening and why it is happening and all those stuff, all you can do is simply click on the payoff diagram, and payoff diagram you will be able to see the chart basically. It's taking a bit of time. Just a sec. So click on strategy deck. So let me go with the bull call spread. 300, 800, 400, 800. Here it is. See, so here is the payoff chart basically. So you'll be able to see at what point your payoff will be. So how much you are going to make profit and how much you are going to lose at certain point. So here it is saying 14,612. So here when the market closes at that number, you will be losing about 14,000 rupees and so on and so forth. So you can clearly see it comes out around -110, and this point is nothing but your break even. So break even arrives at about 15,649 is something that we earlier said, right? 15,688 was the break even. So if market closes at 15,688, you'll be break even. Break even means no profit, no loss. So going forward on top of that, you will be making profit. So if market moves ahead, you'll be making profit, and the maximum profit that you're going to make is for this particular one is 3,330. So previously when I was showing, the market was something else, and now the market would have changed, and because of that the numbers have changed. So here you will be able to see the payoff diagram. Right. So you can change the quantity as you want, and accordingly you can see the premium is changing, max profit is changing, max loss is changing, right? So you can trade whichever way you want basically by simply clicking on this. So margin is nothing but the margin, because this is a bull call spread. The amount of premium that you have paid is nothing but the margin. But in here, this is there is a sell leg as well. So based on exchange calculation, it has given you the margin benefit over here. So the overall margin benefit that you've got, that we will see here. So once you click on trade, right. So here, once you click on trade, you'll be able to simply submit the orders, and then your orders will get placed. So simply over here, you can even change it whether you want to go with the market or you want to go with the limit, right? So if I submit the market, the price will go through. So let me just click this here, clear this here, and then I will click on option express again. Okay, and then I will click on strategy deck again. So this was basically the example that I have given for the Nifty. You can select whatever scripts that you want over here. I mean, you can go with the stocks, you can go with Bank Nifty, you can go with anything else that you want. You can. This was the above example. Then I have the example below as well. You can go with the strategies if you think the market is going to go down. So accordingly, you can select the spreads that you want, whether you want to go with the bear call spread, bull, if I click on put, then it gives me a bear put spread, then on the expiry, and so on and so forth, and the spread there. The next is the between. If you have a view whether the market is going to be between 15,750, let's say, and 15 and 16,000, let's say. So if I click here, it probably will throw. Yeah, so it has given me like 7 different trades because I haven't clicked call here. So even after clicking on the calls, it is giving me like 7 different trades for Nifty between 1572 and 16,000. So these are the strategies it has given. All you need to do is just click on short strangle or straddle that it has given you. All you need to do is just go and sell 15,600 and 15,900 short strangle, and the profit, maximum profit that you're going to make is like 5,320, and the limited, as you said, as you already know, that selling poses a very huge risk. So the loss is potentially unlimited, because market can behave erratically. Margin required here will be a little bit high, because both the legs are having sell legs. And as I explained you the calculation, it is more or less exactly the same. All you need to do is just click on trade, and then you're good to go. Similarly, if you want to trade for any other expiries, you can just click on it and you can trade on it. So that was all about the strategy deck. Next, I will start with option chain. So once I click on option chain, it's taking a bit of time to load. Just a second. Right. So here is the option chain. By default, it is going to show you Nifty option chain. Here you will be able to see the live prices of the Nifty option chain, and then it will bring you directly onto the the ATM options. So at the moment, the current market price is about 15,745, 15,743. So 15,700. So this is where you will be able to see the live option chain. You can see the LTP changing, and you can see the LTP changing for this live option chain. Let me go through the components over here. So here by default it is showing Nifty. Then you have this select expiry date. You can select expiry date of the 7th July if you want, or if you want to go with the current expiry, which is just a sec. I clicked something else. So 30th of June basically. So it will show you that, and then there is a tick and untick option to show Greeks. Lots of option traders, they like to trade using Greeks. So all they have to do is just simply click on Greeks. Most of the platforms, they don't give you this kind of information for free. On ICICIdirect platform, these information is available to you for free, basically. The next is overpriced and the underpriced. You can see all these analysis at the extreme left of the columns. It says UP, OP. So UP is nothing but underpriced, and OP is nothing but overpriced. What it means is underpriced and overpriced. So underpriced is nothing but when you go into the market, if something you have bought for 95, but the actual market price is about 100 rupees, then the price that you've got at underpriced basically. So the current market price for this particular, so in options term, if I see 5,900, the current market price is about 50. It is saying this is underpriced. So what exactly it is supposed to be? So 50 is actually, it is cheaper at the moment. It is supposed to be higher, but it is trading cheaper at the moment. Similarly, if I see the OP, let's say with 16,200, it is trading at about 452. This is quite expensive at the moment for lots of traders. It is supposed to be slightly cheaper than this. There are plenty of other how much cheaper, that we will get to know further in the scanners as well. You will be able to identify how much cheaper, and based on that you can make the decision. So what decision you'll be making in this is, if it is cheaper, then you have to buy it, and if it is overpriced, then you have to sell it, because there is a tendency of the market that prices tend to revert back to mean basically. So what it means is, if something is overpriced, it will find its way to set at the market price, whether it is overpriced or underpriced. So if it is underpriced, it will go upside. If it is overpriced, it will come downside. So that's all it means basically. Greeks we have available here is delta, theta, vega, and gamma. So let me just touch base on what exactly all these Greeks means. So let me go on to the slide, and I'll be able to give you a brief explanation of what each Greek means. So delta is nothing but measure of change in option premium due to change in the underlying price. So what it means is, if 1 rupee change in the price of the underlying changes, accordingly the delta of that option will change. So if I take an example over here for the at the money, for at the money, let's say, let me go with this 0.52, which is 15,750. What it means is, if Nifty changes by 1 rupee, this particular delta, the price of this option will change by 52 paise, basically. So you will be able to notice that if the price of the Nifty changes, you will see that 52 paise will be the change in the option price, basically. So that's what the delta means. Similarly, gamma is nothing but we sometimes call it the second order derivative, which is nothing but the measure of change in delta due to change in the underlying price. So what it does is, now the first order was when the price changed, the delta was changing. Now who changes the delta? Because once the price changes, delta changes, but then at the same time this 0.52 will increase as well, because the price of the Nifty is also changing. So this 0.52 may become 0.53, 0.51 or something like that. And why it happens like that? The gamma is the the factor that adds on to the delta. So if the market is going up, the gamma will get added onto the delta, and if the market is going down, the gamma will get reduced from the delta. So that's how the calculation basically works for this gamma and delta. The third is basically theta. Theta is nothing but, I think most of the option traders, they like to trade options just because of this theta, the time decay. Time decay is nothing but as the time goes by, the price of the premium, the price of the option, basically it drops because of the theta decay. So theta here it says is, let's say, -24. So -24 is nothing but the entire day's value that it will erode for the day. So at the moment, if you see, LTP is about 146 rupees. So 146, by the end of the day, you will expect this 146 to drop down by 24 rupees, and whatever the price it will come, let's say about 120. So you will see, if you short this, you will see the price of this particular strike price will remain somewhere around 120 if nothing else changes. But the market is not like that. There are plenty of factors that acts on it. So this -24.5 may not be working in exact same manner, because there is plenty of other Greeks that acts on, implied volatility that acts on as well. So that's how it might affect. But if everything else is constant, and if you have shorted this, you will expect this 24.5 to get reduced from this last traded price of the market, basically. So that's what the theta is. Next is Vega, measure of change in option premium because of change in the market implied volatility. So before this, before get onto the Vega, first I'll need to cover what is implied volatility, basically. So I have a slide on that. So what is implied volatility, basically? So implied volatility is nothing but the perception of the market, of how much the price is expected to move over a given period of time, basically. So what it means is, so let me come over here. So here it is saying 15,700. This is about 19%, basically. So IB is actually given in 19%. So 19, what exactly the 19% means? So 19% means that the price, if a price of a stock is 100 rupees, in next 1 year it is expected to move 19 rupees up or down, basically, and that too with a probability of 1 standard deviation, which is nothing but 62%, 68.2% probability. So if a price of stock is rupees 100 and the option chain IB of, in our case we were looking at 19, is given, it means that 19% annual volatility is forecasted ahead of 1 standard deviation. In other words, the price of the stock will move 19 rupees plus or minus from rupees 100, right? So that is how it is calculated. Option traders, that these numbers is nothing but annual volatility. So option traders, they tend to convert this annual volatility into days volatility, and then based on that they calculate how much movement is expected for that particular strike price and so on and so forth. So why I went to implied volatility, because implied volatility and Vega goes hand in hand. Vega is nothing but the change in option premium with respect to implied volatility. So what it says here is Vega, if you come on to this 15,700, if you see, it says 5.5 rupees basically. So what it says is implied volatility here is 19. So if implied volatility increases by 1%, the price of the option premium will increase by 5.5 rupees basically. If the implied volatility drops by 1%, so let's say from 19.11 it drops to 18.11, the price of this option premium will drop by 5.5%, 5.5 rupees. So basically 146.65 minus 5.5 rupees will be the so 145.5 is right now. So if it decreases by 1%, the price of this option will become 140 rupees. So this is how Vega and implied volatility goes hand in hand. And if you have such kind of knowledge and such kind of information, you can immediately understand what will happen to this, implied volatility. But then you will have to understand how implied volatility behaves basically. So that's for the implied volatility. Next comes is rho. This is nothing but the interest rate in the market, which is normally calculated based on 10% as given by the NSE. So that is nothing but the risk-free rate, or you can call it as interest rate, which is nothing but again a risk-free. And all these informations are actually put into the Black-Scholes model, Black-Scholes formula, and based on that, all this informations have been given out. So so onto the option chain, you can simply the analysis is given as buy and sell. You can simply click on, so if it is underpriced, I will simply click on buy. The last traded price is 70. I will simply click on buy, and you will be able to see it over here. And if I want to sell this, if this is underpriced, I want to sell this, I can simply sell it, and then again I want to buy it, I can buy it. So at the moment you can add up to like 3 different scripts and simply click on trade, and you'll be able to go you'll get this basket, and then you'll be able to simply submit it, and your orders will be gone through into the exchange. And then if you want to go and square off it, you'll have to go onto the open position, and then you can go and square off it from that once your orders is executed. So coming back to the option chain again, right? So option chain was, that's it. Next we will be covering is scanners. In scanners there are plenty of tools available out here. Bullish, bearish, neutral, indices, IV scanners, premium discount, long short buildup of the futures, most active options, OI limit, active stocks by put call ratio. PCR is nothing but put call ratio, and it also gives you the information on what stocks have actually gapped up and gapped down from the previous closing price of the stock. So let's go one by one. The first is bullish trend, which is given here. So it gives you 2 different options. The first is in the money option, and the second one is the out of the money option. So for bullish trend, for the contracts that are in the money at the moment, you can see that at the top one you can see ITC. You can even filter this based on the price that you think. If I have clicked twice, the top, the highest the premium that you can see here for the 1307 is for the Maruti. And if you are something novice traders and don't want to spend too much money, you can see the IDFC first is given, which is in the money at a price of 3.9. This is nothing but the lot size multiplied by the bid price that you'll be paying, and this is the total return that you can expect. And the current underlying price for the IDFC first is 31 rupees basically. All you need to do is just click on buy or sell. Because this is bullish, you'll be expecting it to buy, but if you want to sell it, you can even do that. So what it says is 30th June call it is. So let me just click on buy button over here, and once I click on buy, it will bring you over here, and you'll be able to see the one lot of IDFC Bank is about 11,100 quantity. And once you multiply this by this, this is what the margin that you'll have to pay because you are buying it. If I simply sell it, simply click on sell, then the margin will change immediately, which is about 2,11,000 rupees. Yes, and you can even see the latest price over here, which will keep changing because this is stock that is because these are some illiquid stocks. The price of these illiquid stock doesn't change very frequently, so that's why you're not able to see it over here. But yeah, so all you need to do is just go over here, place the order, and you're good to go. So on Option Express again. So that was for the bullish recommendations for in the money, and for the out of the money you can do exactly the same. All these contracts which are actually going out of the money at the moment, you'll be able to trade using simply by clicking buy and sell on the button, and the returns that it has given you is here, and the bid price over here. Next is similar to bullish, is bearish. So by putting your mouse on the bearish, you can even read this. This indicates bearish trend in the stock, and covered put strategy is the ideal position basically. So all you need to do is basically take some stocks of the Bandhan Bank and then sell it basically to design your own strategy basically. So yeah, so that was for the sorry, I have actually clicked on the bullish and out of the money. There you go. So it says that. Similarly for the neutral strategy, so once you bring your mouse over, it says it indicates probable volatility in the stock market based on the swing ratio. So long straddle and short straddle is what is recommended basically in this case. So what it says is Ambuja Cement, you can see the underlying price, call price and put price is given over here. All you need to do is just go on to call and put price, and you have to create your own strategy, and then you will be able to sell it. If you want to go and create your own strategy on Ambuja Cements, you can go onto the option chain, select this strike price of 365, and then simply click on sell and sell. So you'll be able to go with the short straddle. If you want to go with the long straddle, you can simply click on buy and buy on the option chain. That's how you can do it. If not, you can even go to the basket order. Here you can select each of the strikes for this particular Ambuja Cement one by one, and you'll be able to do that. So basically, if I go over here, all I need to do is just Ambuja Cement. So 365. All I need to do is just simply sell this. 365, sell this, and then trade. So this is what is going to be my short straddle basically for that. Simply, so you don't even have to go through the the place order where you have to select all the strikes. You can simply trade directly from the option chain. So coming on to scanners again. So neutral strategy, it could be long straddle, it could be short straddle, whichever way you want. Next comes is the indices. In indices, it has given you the type of call, the trades that you want to take, whether it is on the call or on the put. Indices nothing but Nifty and Bank Nifty, so you don't have to go elsewhere to identify what is trading, how much. So all you can do is you can either filter this by strike price, or based on the premium price, or based on the the open interest. So if you want to click here, 88 lakhs is what the open interest on the 16300 call at the moment. So this is where the huge trading is happening at the moment, and based on these kind of information, you can trade the strikes, delta, theta and gamma, just in case if you want to understand what is the delta for this particular one. So if the price of this strike changes, how much the price of the option premium would change based on the delta, and how much theta decay that you can expect for this particular strike. Yeah, So another thing that you will identify here is for this particular 16300 strike, the theoretical price based on the Black-Scholes model should be about 9.87 rupees, but at the moment the price is about 3.8 rupees. So previously I was mentioning how to identify whether this is overpriced or underpriced. So you can identify from here basically. So what it means is, based on mathematical calculation, it should be 9.87 rupees, but in actual market it is trading at about 3.8 rupees. So what will happen is, what strategy I will design for this particular strike price is that I will buy this at 3.8 rupees because I expect it to go all the way up to 9.8. If not 9.8, by the time theta decay will happen, it will drop down to, let's say, 7 rupees or 8 rupees. Even then I will be making a little bit of money on each lots that I trade basically. So that is one way to design it. Second is identifying based on open interest. So what is open interest? So I have created a quick slide over here just to give you understanding of what is open interest and how it is being calculated. So open interest is nothing but the total number of contracts that are outstanding in the market, which are not settled yet. So what outstanding contracts that are outstanding in the market means is the contracts that are open in the market, which are not squared off. So let me give an example on that. So on day one, if A buys one contract and B sells one contract. So if you buy one contract, then somebody has to sell one contract. So if you buy one and somebody sells you one contract, then the total open interest is 1 over there. Similarly, on the day two, if C buys 5 contracts and D sells 5 contracts to B, then the total open interest is 6, because from day one there will be 1 open interest, and these 5 contracts that are open at the moment, altogether it becomes 6. So 1 from the previous day and 5 from today. Similarly, on day 3, if one contract that was open with A and the one contract that was open with B, if they try to square it off basically, so what A will have to do is he will have to sell it, and B will have to buy it. So both of them squares off their position, so then their position get squared off. So now A is having nothing and B is having nothing as well. So what happens with the market is the total open interest was 6. So because this one contract gets squared off, it drops by 5. So it drops by 1. So the total open interest now remains is only 5. Similarly, if you go one day ahead, and if C decides to sell only 3 quantities, and at the same time D also decides to square off his position by 3 contracts, then the total open interest in the market will again reduce by 3 contracts. So on day 3 it was 5 open interest, and then after dropping to another 3, the only open interest that will remain in the market will be 2. So open interest normally keeps changing. It can increase, it can decrease for both calls and puts, and it is calculated for both calls and puts basically. So in summary, it is nothing but the outstanding contracts in the market which are not settled yet. So coming back onto this screen, so what it says is 88.84 lakh number of contracts are actually being traded on this particular 16300 strikes, and these are actually open, and it has not been squared off yet for 30th of June of expiry. As the expiry progresses, we progress towards the expiry. These open interest can increase or it can decrease. Now here it says open interest change. So open interest change, here it is showing in positive. So this has increased by 49% from the previous days close of the open interest basically. So today it has increased by 50%. This has increased by about 85%, 54%, and so on and so forth. Similarly, for the implied volatility, this is again very important. Implied volatility yesterday was whatever it was, but it has increased by 10.8%. So what it means is 10.8%. If the implied volatility of this decreases by 1%, the Vega here it says is 1.8. So the price of this particular strike price will drop by 1.8 rupees if the implied volatility drops by 1%. If it increases, then the implied volatility may, the Vega is about 1.8. So the price of the premium will increase by 1.8 rupees if the implied volatility increases by 1%. So that's how you read this, the indices scanner. Similarly, for the bank nifty, it is just a script. You will get exactly the same thing over here. All you can do is you can simply select it by the change in IV, change in delta if you want to trade, the highest delta, which is 0.65. Similarly for the theta, gamma. So all this is just available at a click of a button. You can simply select it based on your requirement. Next comes is IV scanners. Again, over here, the same thing. You can select it based on your symbol. You can change it based on the IV. So if you want to change the lowest IV, then you can select the IVs over here for the TVS motor, which is nothing but about 49%. And the percentage change, if you want to go and see, you can simply go over the onto the of the IV. So yeah, you can filter this based on highest IV and lowest IV. Then ask price, volume, how much it is getting traded. So you can see there are few strikes which are not even getting traded. There is only very small volume, so you don't need to go and trade on it. Ideally, you should be trading the highest volume and the highest open interest. Basically, over there you will get a good liquidity in order to get in and out of the trade, basically. So delta, theta, gamma, rho, and vega, that I have already covered. Again, and the theoretical price is something that is calculated based on Black-Scholes model, and here you will be able to identify whether the particular strike price is expensive or cheap, and accordingly you can decide whether you want to go for buy or you want to go for sell. So these all things are readily available for you. All it means that you need to understand each component thoroughly and then make the decision based on that. Next comes is the premium and discount for the future contracts. Lots of future traders, they would like to understand whether the particular future contract is trading at premium or it is trading at discount. So for the premium trading, which means that if the price of a particular contract was supposed to be 800, and let's take an example of this MFSL. LTP it is saying as 821, and the premium it is saying is 4.8. So what it means is this particular stock is actually trading 4.8 rupees expensive, or at a premium. So what futures trader will do in this case is, if this is reasonably premium, then what they will do is they will short this particular future, and they will try to ensure that the price settles and finds an equilibrium, and that's when they will be able to get out their trade and they will be able to make the profit. But then this is nothing but naked selling. Similarly for the discount, if some of the futures are getting traded at discount, then what future traders will do is they will be buying it, and once the price moves up, they will try to square it off, and they will pocket the difference, and they'll be able to make a little bit of profit on that. So that was it for the premium and discount for the futures contract. Similarly for the long and short build-up, long build-up, short build-up, short covering, and long unwinding are the four different perceptions of the market, where what is happening in the particular stock. So let me just touch base on the long short build-up and how to understand what it means. So in futures, you need to first understand how the open interest behaves, basically. So if open interest in futures is increasing and the stock price is increasing as well, we say that long build-up has occurred, basically. What it means is more trades are on the long side of the trade. So lots of people, they are actually they want to buy the futures, basically. Similarly, if the open interest decreases and the stock price decreases as well, the inference is that whatever the position that futures traders the long they have taken, they are trying to square it off basically. So longs are covering their position, basically the buying position is getting squared off. So that's what the long unwinding means. Similarly, open interest is nothing but if open interest is increasing and the stock price is decreasing, the inference is that short buildup is happening, which means that more trades are happening on the short side, which means that lots of traders are trying to short the futures. If open interest is decreasing and stock price is increasing, the inference is that short covering is happening. So basically what is happening is all these traders who have actually shorted their futures contract are now trying to buy their contract, or in other words they are trying to square it off basically. So that's what the short covering means. So long unwinding means they are trying to square off their long positions. Short covering means they are trying to square off their short positions. So lots of people get confused basically on these two. Long buildup is nothing but people are buying a lot on the buying, and short buildup is nothing, people are looking to sell a lot. So that's how long buildup, long unwinding, short buildup, and short covering is defined basically to give you a perception. So now based on this, you will be able to identify, you can filter it using volume, the contracts that you want to trade, or based on the price, or in the change, of open interest, so on and so forth. So accordingly, if you can click here, you will be able to see the open interest has dropped by 41%, which means that open interest is decreasing, price is increasing. So open interest is decreasing and the price is increasing, which means that short covering is happening in that particular position basically. I forgot which one I was looking at. I simply clicked it. So Adani puts basically. So something like that. Here you can filter it with future index, option stocks, or option index. Same with near expiry, next expiry, or the far month expiry basically. Short buildup, short covering, and it will give you all the information related to what is happening in that. So you can just simply go and select it. We are running short of time. I will be covering the rest of the 3-4 points, and then we will be taking the question and answer session. So I believe you'll be posting some questions in the in the chat section, and once I'm through with this, I'll be able to take some questions on that as well. So most active options is nothing but the most active options that are being getting traded. So here by default you will get a Nifty, but you can select the stocks that you want. Segment is derivative, and then whether you want to choose whether to go with the call or the put. So it will give you the most traded options in this case. And again, you will be able to filter it based on the open interest, because lots of people, they would like to trade the contracts that are getting traded a lot. So that is nothing but the most active options. It is self-explanatory, and you'll be able to explain check that. Next comes is open interest limit and change. Again, it's the same thing that I have explained you here with the open interest, but then this was related to futures. In the next webinar session, I'll be covering this open interest in detail, how to use open interest to trade options in detail. So I will be leaving this for now, because in next session I'll be covering this particular open interest, and this then only it will make sense if I cover both of them. Next is active stocks by PCR. PCR is nothing but put to call ratio. So what happens is basically what they do is they so I think I have another slide on the put to call ratio as well. So put to call ratio is nothing but it can be either volume based or it can be either open interest based. What they do is they combine all the volumes on the option chain, they take a calculation of that, and then they do exactly the same thing for the call as well. Put to call ratio is nothing but when the value of put is the ratio of put to call is taken, you will get either the value either below 1 or above 1. So just a sec. So if PCR is greater than 1, which means that there is more demand for the put side, which means that lots of people want to trade in puts, and ideally the puts, lots of people, they try to buy puts, which means that market is going to fall. So that's how people understand using PCR. Similarly, for if the PCR comes out to less than 1, there is a more demand for the call, which means that people are expecting the market to increase basically. But certain people, certain traders, they also call this as a contrarian indicator, because if PCR is greater than 1, which means that market is already falling basically. So what they say is, if market is already fall, then it is going to come back to a mean, which means that it is going to go rise. So that's why if some people like to short here, some people would like to buy here, because they see that market has already fallen, and now it's going to take the reverse position. Similarly, they will be thinking that here that the market is already is on the peak. So as a contrarian, they will try to short this particular the strike based on that put to call ratio basically. So here you will be able to see this Hero MotoCorp is 1.73, Maruti, REC, ACC. So ACC is neutral basically, so people won't be taking any position here unless and until they have a clear idea of where it's going to go. Here they would get a clear idea of 1.73, which means that there is a huge demand for the puts, and you can decide among yourself, because there is no right or wrong answer for this, because some people will go this way and some will go contrarian. It is up to the trader basically how they want to go and trade it. Next is gap up and a gap down. This is nothing but the information that you will get from the previous close, whether what particular stock has actually gapped up and gapped down, and by what percentage and everything. And if you want to trade on this particular one, you can simply filter it based on volume, or based on last traded price. If you want to go a little bit more cheaper option, the futures and stuff, you can even filter this by option index, option stock, future index, and so on and so forth. So that's it for the scanners. In the next session, I will be covering screeners, open interest, price calculators, and gainers. So that and open interest, I'll be explaining you a little bit more in detail, and that's it. So now I'm open to questions. So let me see if I've got any questions out there. So chat. Okay, fine. There are plenty of questions here. So probability of profit, where I can see. We at the moment there is no probability of profit available on ICICIdirect, but we are working on creating one. Soon when we will have available, you'll be able to see that. Option premium कितना ऊपर और नीचे होगा कैसे पता करें? Option premium, how much it will go up and down can be captured using implied volatility, but for that you will need to understand implied volatility in depth. Implied volatility, what happens is the current market perception of the traders, and during the day implied volatility increases and decreases as well. So one thing for certain implied volatility traders, what they do is they try to analyze the implied volatility over the last few years or the last few weeks or the last few months. They understand the pattern of the implied volatility of that particular let's say for example Nifty or Bank Nifty, and for the 18 strikes they will understand that whether the implied volatility is increasing or decreasing And once you understand that behavior of the implied volatility, you will be able to take the position that the option premium is going to increase or decrease. So let's say, for example, I gave you the example of if the implied volatility was about 20%, and in the previous few days you have seen that the implied volatility from 20% it drops down to 18%, and then again on the next day it comes back to 20%, and then again it's dropped down to 20%, and then again on the third day it goes to 21%, and then drops down by 3% again. So if you understand this kind of pattern, then you will be able to make a decision whether you want to go short or you want to go long based on the implied volatility. OP and up by what amount, 5 rupees, 10 rupees, etc. can be checked. Again, as I mentioned, this again needs to be taken in conjunction with implied volatility, and then you will be able to understand whether it is overpriced or underpriced. Again, this is calculated based on the theoretical price and the current market price. If the theoretical price is saying, using Black-Scholes model, that the price of the particular strike needs to be, let's say, 10 rupees, but it is trading at 8 rupees, that means it is in a discount. So all you need to do is simply just buy it, and then you can expect it to find an equilibrium price which is 10 rupees going forward. Similarly, if the price theoretical price says it is 10 rupees, but then the particular strike price is trading at 12 or 15 rupees, then you can short it, and you expect the price to drop down to find an equilibrium place here. Is it available in mobile app? Sorry, not yet, but soon we are working on it, and we will be bringing this on the mobile app as well, on the markets app. Will this recording will be available after the live broadcast? Yes, of course, definitely. All you need to do is immediately after this webinar gets over, you can simply click on the link that is given to you. You can go through the link whenever you want, and you can see the recording, full recording available at the same link, basically. Is it a risk to use market order in options trading? It depends upon the trader to trader, because market order, if you're trading in a very highly liquid stocks, then market order is somewhat, especially with Nifty and Bank Nifty, lots of traders, they go with market order. So there is no harm in that, because there is a huge liquidity and your orders will get filled almost instantly. But for the illiquid stocks, market order is risky, because what happens is there are traders out there, they will try to hunt you down. So by the time you click and try to execute at the market order, they would have completely disappeared, and the very next the order that available is quite far away, so you may lose out on the spread, basically. The cost basis will increase for you. So for the illiquid stock, it is risky, but for the liquid stock, especially with Nifty and Bank Nifty, lots of people, they go with the market order, so there is no harm in that. Where is Option Express link in ICICIdirect site? So let me go back to my screen again and show you. So once you are on the FNO page, all you need to do is click here on plus sign, click on Option Express. You'll be able to go through the Option Express, or there is another way. Click on FNO. Here in Smart Option Analysis, you'll be able to click on Option Express, and you'll be landed onto the Option Express directly. Coming on to this questions again. Terminal volatility means. I have actually covered that in my webinar, what exactly the word implied volatility means. So if I want to quickly touch base on that, implied volatility is nothing but a perception of the market, how much the price is expected to move over a given period of time. You can go through the recordings and you will be able to understand this in deeply. So yeah. So if we build one strategy, and shall we square off that particular strategy alone? as all the Nifty and Bank Nifty open positions are lifted in one page. If we build one strategy, and shall we square off that particular strategy alone? It is up to you. You can go onto the open positions page, and then you need to identify the likes that you have taken. Recently we have come up with the Nifty and Bank Nifty. So if you have taken like 3 different legs in the Nifty, you can you can see the legs within the Nifty tab, and you can click on the checkbox whether you want to square off that particular strike price or something else. You'll be able to use that on the checkbox basically. I think that's it for the questions, I guess. Yeah, that's it. So thank you very much for participating in this exclusive webinar on Option Express. This was the first part. As I mentioned to you earlier, the next part I will be covering on 5th of July. Just a sec, at 11 at 11 a.m. at the same time. So stay tuned and participate in it to understand a little bit more about options, and you will be able to gain a lot from this webinar. So please keep participating, and thank you very much for today. Thanks. Bye bye.